love the channel and find it useful in becoming a happy retiree. Subscribe today. We're going to Lynn, who joins us on the line from Avondale Estates. Lynn, good morning. Welcome to Money Matters. How can I help? What's going on?
Good morning. Thank you for taking my call. I am retired and am fortunate enough to have enough of pension and Social Security that I can live modestly but comfortably. I do not have a mortgage on my condo, but I do have a home equity line of credit.
Got it.
That is up a bit because I have been needing to help a family member, and I have just done some upgrades on my condo.
Tell me about Lynn, tell me a little bit about the amount of the home equity line and how it's priced. What does that look like? Meaning, what is your interest rate? What does it cost? How much is your payment?
My interest rate is about, but I think that is variable.
And
that can change.
Sure. Okay. So it's probably tied to either LIBOR or the prime rate, and it certainly can go up as interest rates float higher.
Right. The line of credit right now is just under $50,000, between $45,000 and $50,000.
So it's between $45,000 and $50,000. Okay.
That I have on the loan now. The total line of credit is $90,000.
Okay.
And since it is variable, and since you were talking about that interest no longer being deductible, I am wondering if I need to mortgage the condo and pay that off.
It just to have a regular mortgage as opposed to the HELOC.
Right. Will that be to my financial advantage under the new tax law?
Well, okay, so a couple of thoughts here, Lynn. Do you think so? So the cost of this HELOC every month is probably what? I'm gonna venture a guess of $400 a month.
I can pay as little as the interest. I usually pay about $1,000. So
you are certainly from an amortization standpoint, you're paying this thing off right now.
Oh yes, I'm paying it off.
Got it. And then about how much do you have after tax savings? So not IRA money, not 401k money.
I am not touching my IRA.
Got it. But after
I will have to begin pulling this year, but I do not plan to touch my IRAs or my investments in my lifetime.
Okay. So I think a couple of thoughts here. If you have this as so the rate right now is tied to something that floats. So you've got LIBOR, or you've got it's probably tied to LIBOR, or it's tied to the prime rate, or something that can move as the
prime rate, I think.
Okay, and as the Federal Reserve increases interest rates, so can the cost of your loan. However, the amount of this loan that's let's call it $45,000. Is, in my opinion, it's not enough to go and refinance this, because if you're paying $1,000 a month, this thing could be paid off in a couple of years, right, Lynn?
Oh yeah.
Yeah. So I think if you're paying this thing off to the tune of $1,000 a month, then this thing is going to be paid off in, well, if we just do some math, around. Let's call it 4 years from now. So I don't think that it is, I don't think that it is helpful or advantageous in the long run because of the cost to do any sort of refinance or even make this go back to a permanent mortgage. I think it'd be tough to do that anyway. I've talked to mortgage lenders. They don't want to do an actual mortgage versus a HELOC, anything that's under $100,000 anyway. So I think that if I were you, I would continue the same payoff schedule that you're doing, Lynn. You may even want to excel.
Every penny on it I can.
Yeah.
I do not like to pay interest.
Yeah, I think you're doing the right thing by doing this. I think it's too expensive, Lynn, to go back and restart and do a whole nother loan or refinance. Just finished up with a call about a HELOC. So again, home equity line of credit. You've heard lots of fodder about this potentially from the new tax law that HELOCs are dead. They're no longer tax deductible. But I believe it's a little more nuanced than that. And everything that I've read about HELOCs is that what you can, let me try to clarify this. There's no longer can you just use a home equity line of credit. Let's say you've got a house that's worth $500,000, you owe $200,000, you've got a $200,000 equity line that the bank would let you go and take. So you open up the equity line, you go buy a camper and you buy a boat and you pay off $10 grand worth of credit card debt like you used to be able to do, but you still deduct all that under the old rule. From what I'm reading, the way HELOCs are now moving forward, it really matters what the use is for. So no longer can you deduct a bunch of non-home improvement or non-housing related costs. You can't go, again, buy a boat and a camper, pay off credit card debt under the new HELOC rules and still deduct that interest. From what I'm reading and how I'm interpreting this, that is what has been killed under the new tax law in 2018 moving forward. But the way I'm understanding it is that if it's still home related, you're putting an addition onto your house and you need to borrow $50,000 in equity line to do that, from what I'm understanding, that could still be tax deductible under the new plan. Now, remember, there's a lot of nuance to every new tax code. There's still CPAs themselves trying to figure this out. So we're going to keep an eye on this provision as I talk to more and more CPAs. Ask your CPA about your HELOC, see how they're interpreting that rule, and we will keep you updated here on Money Matters about the use of this very important rule when it comes to the mortgage interest on a home equity line for your home or other uses. Hi, I'm Wes Moss, and thanks for taking a minute to hear about what's so different about my new book, You Can Retire Sooner Than You Think. So unlike other retirement books, this book will give you a step-by-step guide, whether you're in your 20s or 30s or 40s or 50s, to learn from what these successful and happy retirees did to get there. I hope you enjoy the book, but more importantly, I know that it'll help you retire sooner than you think.